Hey everyone, welcome back. Today we're diving deep into the world of investor relations. We're going to explore the side of business that's, well, more than just spreadsheets and stock tickers. We're tackling investors and other stakeholders today, and it's more than just a dry document, believe me. We're going to uncover some surprising connections and, well, ripple effects that you might not expect. First things first, let's break down the basics: debt versus equity. It's the foundation of how companies get the cash they need to operate, but what's the real impact? Not just for the company, but for you, for anyone trying to understand how this whole thing works. Let's say you're an entrepreneur. You've got this killer startup idea, right? You need capital, you need money to grow, but there are different avenues to get there, and each has its own, let's say, personality. Debt. Think of it like a business loan. Could be from a bank, could be issuing bonds. It's generally seen as the lower risk option for investors. They're getting those regular interest payments, and eventually they get their principal back. Steady and reliable, like a marathon runner.
Equity, on the other hand, well, that's like offering someone a slice of your company, a piece of the pie, in exchange for their investment. This is where things get, well, a bit more exhilarating.
Yeah.
The risk is higher for investors because their returns, directly tied to how well the company performs. If the company takes off, their returns skyrocket. But if the company falters, they could lose big, maybe even everything. It's more like a racehorse potential for those huge wins, but, well, also a greater chance of a stumble. Now, our source material, it highlights this concept called leverage, basically using debt to try to pump up those returns, like throwing fuel on a fire. But, and this is important, too much, and, well, things can get out of control. They give this example comparing two companies. One's entirely equity funded, playing it safe. The other, they're using debt, leveraging to, well, trying to speed up their growth. Let's say the market's hot, revenue jumps up by 20%. The company using leverage, they see a much bigger return on equity, ROE, for you acronym lovers. It's a big deal for investors, a measure of profitability. So leverage in this case means a larger piece of the profit pie.
But here's the twist. What happens when the market takes a dip? Let's say revenue drops by that same 20%. That leveraged company, they're facing a much steeper loss compared to the company that's stuck with equity. So it's that classic risk versus reward dilemma. Leverage can be powerful, magnify gains when things are good, but it can also make losses sting a whole lot more when times are tough.
It's a constant balancing act. And that balancing act, that tension between risk and reward, it's at the heart of every decision in finance.
This whole risk and reward thing, it's not just some abstract concept, It gets even more interesting when we zoom out and look at the bigger picture. Our source material, especially Exhibit 6, it paints this picture of like a web, right? All of these different players connected. We're not just talking investors here. We're talking employees, suppliers, customers, even governments and the environment, believe it or not. They all have a stake in how a company performs. Every decision a company makes, every single one, from where they get their materials to how much they pay their employees, it all creates these ripples. And those ripples, they impact this whole network, sometimes in ways we don't even think about at first. Check out the Volkswagen case study. It's in our materials. Did you know that the German government, they actually own 20% of Volkswagen?
Yeah.
Yeah, that gives them veto power. They can overrule major decisions. It really makes you think, right, about who's really calling the shots. You've got this huge global company, but a big chunk of the decision-making power, it's in the hands of, well, the government. It shows you the influence that stakeholders can have.
It's a perfect example of that debate, between shareholder theory and stakeholder theory. Shareholder theory, it's pretty straightforward. A company's main responsibility, make money for the shareholders. That's it. Maximize those profits. But then you've got stakeholder theory, and it's like, hold on a second. Don't we have a responsibility to think about everyone involved, not just the folks with stock certificates? It gets tricky, right? Should we prioritize the environment over profits? How do you balance what employees need with what investors demand? It's messy, and that's what makes it so fascinating.
Talk about a balancing act. And speaking of balancing acts, let's talk about ESG, environmental, social, and governance factors. It's more than just a buzzword, all right. ESG, it's a framework. It's how we evaluate a company's impact beyond just the dollars and cents. And our source material, especially Exhibit 7, it's got some really eye-opening examples. We're talking about a company's carbon footprint, how they treat their workers, are they sourcing their materials ethically, even the diversity of their board of directors. And here's the thing. Ignoring ESG, it's not just bad PR anymore. It can actually hurt a company's bottom line. Investors, they're starting to care about this stuff, and companies, they're feeling the heat. Remember that awful dam collapse in Brazil, the Brumadinho disaster? That was a harsh reminder of what happens when companies don't take environmental and social risks seriously.
And let's not forget about data breaches. Equifax, right?
Yeah.
That was a failure of governance, plain and simple. Cybersecurity matters. The million-dollar question, though, is how do you measure ESG? How do you put a price tag on, like, social impact or ethical sourcing? It's a real head-scratcher.
It's a tough one, right? How do you put ESG into a spreadsheet? But matters, you know?
Yeah.
It's not just about the numbers anymore. And you know what? Thinking about all this, it makes me realize that, well, we're all stakeholders in a way, even if we don't own a single share of stock. Think about it. Every time you buy something, when you choose one brand over another, heck, even when you click on an ad online, you're interacting with a company. And you're kinda, sorta, voting for how they do business. So knowing what we know now about investors, about stakeholders, does it change anything? How do we look at these companies differently?
That's the big question, isn't it? We're not talking about, like, robots or algorithms here. We're talking about people, communities, the planet, all affected by the decisions these companies make. And as we peel back the layers, as we learn more about this whole investor-stakeholder dance, well, it forces us to ask ourselves some tough questions.
Yeah, for sure. Like, what if you're worried about climate change? Do you invest in those companies trying to be more sustainable, even if their stock price isn't, through the roof right now? What about ethical labor practices? Would you pay a bit more for a product? Knowing that the company treats its workers fairly, sources its materials responsibly, it's something to think about, right? Because we have power, you and me, as consumers, as stakeholders. We can nudge these companies in the right direction. Well, folks, we've reached the end of our deep dive into the world of investors and stakeholders. Hopefully, you're walking away with, well, a new perspective, a better understanding of what makes this whole thing tick. Remember, knowledge is power, right? And the more we know, the better decisions we can make, not just with our money, but as citizens of this planet. So keep asking those questions, keep digging deeper, and until next time, happy diving.